Hey.
Hey, what's up?
Okay, so I've had a stroke of genius.
You still there?
Mm-hmm.
Okay, great. So it's about investing in real estate. Now listen to this. You know how it would be nice to maybe buy something like a rental property and rent it out, but it's just way too expensive to afford a home? Well, what if we got a whole bunch of friends together and then we all pooled our money, bought a house, and then rented it out together?
That doesn't sound like the worst idea in the world. Have you asked anyone yet?
Yeah, the initial interest seems to be really positive.
Oh yeah? How many people?
A bunch, yeah. Called all the bros. Called the squad, you know?
The squad, eh? I've never seen this squad. How much money are they willing to put in?
Let me tally up the grand total here 1 second. Looks like the boys are putting up $100.
Mm-hmm. Hope you have a lot more friends.
Oh yeah, no, that was just like the first test group. I got tons more.
Like who?
Like, Hugh. Yeah, my buddy Hugh.
Hugh who?
Hugh Jackwoman. Hugh Jackwoman.
Hugh Jackman?
What? Hugh Jackman? You think I'm making up having friends? I need to get some friends. What if I told you there's a way to invest in real estate and get all of the benefits that comes with it, including that passive income cash flow, but it only required $100 to get started? Well, don't answer that question because I already know what you're thinking. You see, I know you're a smart cookie because, first of all, you're watching Cash College. So you're probably thinking to yourself right now, well, Steve, that sounds pretty good, but hold on. What's the catch? A catch, you say? A catch with something in finance? I would be shocked. Absolutely shocked, I say. Okay, so there's no catch, but there definitely is some things to be aware of about this type of investment. So if you watch this video all the way till the end, not only will you learn about real estate investing in general, but you'll also learn about a very low cost way to access the benefits of real estate investing and get an accurate depiction of all the pros and cons that comes with it. Oh, and I also have a little important announcement at the end of the video because I really want to get your guys' input on something and kind of participate in it with me, so make sure you stick around for that too. So in our modern world, one of the traditional pillars of building wealth has been buying real estate. A huge part of this is that when you invest in real estate, it allows you to leverage your money. And that's because, for example, let's say you put a 20% down payment on a home. That effectively means that you're multiplying the power of your money by 5. This is extremely powerful. It allows you to own a very high value asset at a fraction of what it would cost to buy outright. Secondly, mortgage payments towards your home act kind of like a forced savings vehicle. And what I mean by that is part of your mortgage payment goes towards paying down the principal loan on your property, which effectively means that that money is being used to build home ownership equity, which ultimately translates to you building wealth. So by having to pay a mortgage every month, it forces you to save this money and transfer it into the ownership of your home. Third, real estate has been one of the best performing asset classes in history. I mean, people will always need homes. Fourth, owning a home has traditionally been a very important part of retirement, and that's because if you look at the net worth of many retirees, you can see that their home ownership makes up a significant percentage of their overall wealth. And finally, home ownership also has some really great tax benefits in terms of what you can write off against your home, as well as how rental income is treated. And so these benefits can apply to you whether you're a homeowner or a real estate investor. So I think it's safe to say that owning a home sounds great. There are so many benefits to owning one. But here's the problem. Younger generations like mine and maybe yours are facing a home affordability problem. Home values are just skyrocketing right now while wages have been stagnating for a long period of time. I remember my dad once telling me that when he first got his CPA, which is a Chartered Professional Accounting designation, he went to go work at one of the biggest accounting firms worldwide. And his starting salary was somewhere around $22,000 if I remember correctly. So that was probably about 30 years or so. And then he and my mom would go on to buy their first house for somewhere around, I think, $100,000. Now, fast forward 30 years into the future, and my brother's actually following in my dad's footsteps because he's in the process of getting his CPA right now. And guess what the starting salary would be for someone in the exact same position that my dad was when he started? About $45,000. But the difference is that if my brother wanted to go and buy his first home right now, he'd probably be looking about $400,000 for a home in the exact same area that my mom and dad bought their first home in. So to understand what the heck is going on here, let's look at a few charts. Now this first chart is nominal wage growth. So basically what this is showing us is it's showing us how fast wages should be growing if they grow with inflation. So they're starting at $22,000, which is where my dad first started out as a CPA. And then 30 years into the future, if wages are growing with inflation, they should end up somewhere around $47,000. So since my brother now 30 years later is entering the workforce at around $45,000, it looks like wages have more or less kept up with inflation pretty well. But that basically means that real wages, or wages adjusted for inflation, are flat. Wages have not grown over and above inflation. And the bad news is home values have. This chart is the inflation adjusted home value growth. It's not a flat line. You can see that homes are growing well above the rate of inflation. So when we plot the two together, wage growth versus home value growth, if we assume that wages grow with inflation and that housing is growing at this faster rate, which it is, we can see that if we start both at a baseline of 100, wages should basically double. They go up to that 200 line. But the home value quadrupled. It's gone up by 400%. So home values have increased by twice as much as wages. In order to keep homes as affordable as they were 30 years ago, wages would have had to have quadrupled as well. It would probably put him in a much better position to be able to buy a home that was valued that much more than it was 30 years ago. But of course, we also have to keep in mind that home ownership has its own unique set of issues, as all investments do. None of them are perfect. First of all, one of the biggest issues with getting into real estate is the high barrier to entry. For example, if you were looking at purchasing a home that was $200,000 and you wanted to put 20% down on that home, you would need $40,000 minimum to even get a seat at the table to be able to buy that home. So being able to participate in the real estate market requires a lot of money to actually get started. Real estate is also very illiquid, and liquidity is kind of a fancy financial term that basically just means how quickly you can buy or sell a particular item. If something could be bought or sold very quickly, then you can say that that would be very liquid. Stocks, for example, can be considered to be very liquid because I can buy or sell one sitting at home on the couch without pants on in a matter of seconds. Real estate is not very liquid because not only do I have to put pants on to go and buy a home, but the entire process is probably going to take weeks, if not months. And another problem with real estate is unless you're quite wealthy, you can't really diversify your investment. If you're just a single person or a person with a family who's buying their one home to live in, you're concentrating a lot of wealth in that one single home. It's very hard to own multiple properties in different locations unless you're very wealthy. But there is a way to invest in real estate that eliminates basically all of these issues. Imagine that you wanted to invest in real estate, but you didn't have enough money. And then imagine that you also knew a whole bunch of other people who also wanted to invest in real estate, but didn't have enough money. Oh wait, I don't even have to imagine that because that's my entire generation. So let's say everybody got together and pooled their money into a property that you guys then decided to basically purchase and then rent out. And then you would split the rental income among yourself based off of who invested the most into the property. Sounds pretty good, right? Well, this type of thing actually exists, and if you have a phone with you right now, you can invest in one in a matter of seconds. It's called a REIT, Real Estate Investment Trust. A real estate investment trust is an investment that you can purchase just like a stock, and that's because its shares trade on stock exchanges. So by buying shares in a real estate investment trust, you can benefit two ways. You can benefit from the rental income that the real estate investment earns, because then they pass that on to you in the form of a dividend. And two, you can also benefit from the capital appreciation of the properties that it owns, because sometimes real estate investment trusts will sell their properties at a gain. So basically you would receive dividends, and the shares of your REIT can also increase in value. The way it works is that a real estate investment trust is basically a company that's set up by investors who then pool their money together and then use it to purchase real estate properties, which they then rent out to either residential or commercial tenants, and then they collect the rent on. And then with this rent, they have to pass the majority of this rent on to its shareholders in the form of a distribution, which you then receive for buying shares in the REIT. And the dividend that REITs pay out can actually be quite high. That's one of the most appealing things about them. And that's because according to REIT.com, right now, REITs are paying about an average of 4% in dividends. If you compare that to just traditional stocks like the ones you'd find in the S&P 500, you're probably looking at dividends less than 2%. And again, as property values rise or the real estate market is doing really well, there's a chance that your shares in the REIT can actually increase in value as well. So you get those two components of your return, the dividends and the capital appreciation. So ultimately, investors are attracted to REITs because they provide a really simple, easy to access way to capture the benefits of investing in real estate without having to actually go through all the work of purchasing a real property, and it doesn't require those many thousands of dollars to actually make a down payment. As an investment overall, they're capable of strong returns. From 1989 to 2019, the S&P Global REITs Index returned 9.24% per year on average. And they also provide diversification because REITs generally own several different properties, so all that money is not concentrated into one single home or building. So if you're using a free stock trading platform like Wealthsimple Trade or Webull, after watching this video, you could literally be the owner of a REIT in seconds if you go ahead and purchase one like VNQ, for example. It's important to keep in mind that there's also very many different types of REITs out there. Some kind of specialize in different aspects of the real estate market. So some will buy more residential properties and others will invest more into commercial properties. And there's even some kind of specialized ones that hold hospitals or data centers or even the property that cell towers sit on. And while the properties they all hold may be different from one another, the one rule that they all have to follow is they have to pay out the majority of the rental income that they receive. They have to pass that on to investors in the form of that distribution. And this is what ultimately leads to these very high dividend rates. But also remember that just like stocks, the shares of your REIT can also fall in value, sometimes by a lot. And that's because by investing in a REIT, you're essentially concentrating on the real estate market and all the risks that come with it. If you look back in 2008, the real estate market got absolutely hammered. I believe many REITs lost over 50% of their value at that time. So don't be under the false assumption that REITs are a very safe investment, because they're really not. They do carry a good amount of risk. If you look at many of them right now, you'll see that they're having a pretty hard time during COVID. So now that you know a little bit more about REITs and you know how they solve a lot of the problems when it comes to real estate investing, the question now is a REIT a right investment for you? Well, surprisingly, you might already actually be a real estate investor and you don't know it. And that's because if you're somebody who's already an index investor, if you own a total market portfolio, then there's a good chance that within that portfolio, you actually have about 3 to 5% of your money invested in REITs. So you might be thinking, well, hey, that's awesome. I never knew that, but I'm glad I do now. But then you might also be wondering, is 3 to 5% the right amount of money for me? Is that how much I should have in there? Should I have more? Should I have less? Well, according to the paper, Are REITs a Distinct Asset Class? A portfolio of 67% small cap value stocks and 33% corporate bonds produced a better risk-adjusted return than REITs. Aha, so basically what this paper was saying is it's saying that REITs act in a very similar way to an investment that would be a mix of small cap value stocks and corporate bonds. But the small cap value stocks and corporate bonds actually produced a better risk adjusted return than just REITs. So basically what this is saying is it's saying that if you already have a portfolio of stocks and bonds and you have a small amount of REITs in that portfolio, then that's probably the best position for you to be in. There's not really any need to increase the percentage of REITs in your portfolio because they do not produce a better risk adjusted return than stocks and bonds do. And also keep in mind that dividends that you receive from REITs might be taxed differently than just regular dividends that you receive from a standard company. And that's because the distributions that you receive from REITs are a mix of different things. They're not just a simple dividend. They're a mix of rental income. They're a mix of return on capital. They're a mix of a few different things that all ultimately have to be taxed in different ways. So this means that for the best possible tax situation, you're going to want to hold a REIT in something like a TFSA or RRSP for Canadians, or a Roth IRA or 401k for Americans. So ultimately, the choice of whether or not a REIT is right for you is ultimately your decision. And I hope today I've done a pretty good job of kind of illustrating the pros and cons of real estate investing in general, as well as investing in REITs. And I hope that I've also pointed out to you that if you're somebody who's already an index investor and you hold a total market index fund, then you're probably already invested in REITs in the optimal way already. Now, before I go, I just wanted to say that I'm going to be doing a poll on Instagram soon, and that's because I'm thinking about starting this new series I have in mind for the channel, and I want to get your guys' input on what types of things you'd like to see covered on it. So if you're not already following me on Instagram, make sure that you do so you can keep an eye out for when this poll takes place, and then you guys can provide your input. I would really appreciate it. And with all that being said, thank you so much for watching, and I'll see you again soon.